$230 billion. That is the combined capital expenditure Microsoft, Google, Amazon, and Meta funneled into AI infrastructure in fiscal 2025 alone. Yet their collective net income grew just 40% while CapEx doubled. The market is asking a brutal question. Where is the return on this unprecedented silicon binge? Microsoft spent $56 billion on property and equipment in 2025, a 60% jump year over year. Azure AI services now contribute 13 points to cloud growth, but the company's $350 billion backlog implies multi-year visibility. Satya Nadella calls it building the compute substrate for the next decade. Alphabet deployed $48 billion in CapEx, with tensor processing unit v6 pods coming online across 15 regions. Google Cloud reached $43 billion in annual revenue, yet operating margins compressed 200 basis points. The TPU fleet now handles 40% of internal AI workloads, reducing merchant silicon dependency. Amazon's $83 billion CapEx dwarfs peers, driven by AWS custom Silicon Trainium 2 and Inferentia 3 and a gigawatt-scale data center campus in Ohio. AWS revenue hit $105 billion, but free cash flow turned negative for 2 consecutive quarters as power infrastructure lead times stretched to 36 months. Meta committed $38 billion to Reality Labs and AI clusters, deploying 200,000 H100 equivalent GPUs by year-end. Llama 3.1405B training consumed 30 million GPU hours. Ad revenue grew 22%, yet the market prices Meta at 12 times forward earnings, a discount reflecting CapEx skepticism. Oracle's $6 billion CapEx looks modest, but its Exadata X11M racks with integrated RDMA networking target enterprise AI inference. Cloud revenue grew 26% to $12 billion. Larry Ellison argues sovereign clouds and dedicated regions create stickier economics than hyperscale commodity offerings. ServiceNow's Now Assist generative AI features drove 30% Pro Plus contract uplift. With $3.8 billion revenue and $1.1 billion net income, the platform model avoids heavy infrastructure spend. Their strategy: embed inference into workflow automation, monetizing per seat rather than per token. Intel's Foundry pivot remains critical. The company shipped first 18A test wafers to external customers in Q1 2026, targeting high-volume manufacturing by 2027. $72 billion revenue and $21.8 billion net income provide balance sheet ballast, but yield ramp determines whether Intel becomes a viable second source for AI accelerators. Power has replaced silicon as the primary constraint. A single 100,000 GPU cluster demands 1 gigawatt continuous equivalent to 700,000 homes. Utilities quote 5-year lead times for high-voltage interconnects. Microsoft's 3 Mile Island restart and Amazon's nuclear colocation deals signal a new energy procurement playbook. Memory bandwidth economics dictate cluster architecture. HBM3 E12 high stacks now cost $200 per gigabyte, 10 times DDR5. NVIDIA's Blackwell GB200 NVL72 rack consumes 1.2 megawatts, with 40% of bill of materials in memory. Custom silicon efforts by hyperscalers target reducing this HBM tax. Interconnect topology shifts from InfiniBand to Ethernet. Ultra Ethernet Consortium's 1.6T specification enables hyperscalers to commoditize the network layer. Google's Jupyter Fabric and Microsoft's Project Apollo demonstrate 40% cost reduction per gigabit versus proprietary alternatives, directly improving cluster ROI. Inference economics are rewriting the ROI calculus. Training is a one-time fixed cost. Inference is recurring variable cost. Optimization techniques like speculative decoding cut compute 30%. Open-weight models compress the moat. Llama 3.1405B matches GPT-4o on benchmarks at 1/10 the serving cost. Enterprises deploy on-premises using Dell PowerEdge XE9680 with 8 GPUs at $200,000 box, replacing million-dollar API contracts. The software layer captures value. The infrastructure layer faces commoditization pressure. Advertising AI shows clearest returns. Google's Performance Max and Meta's Advantage Plus use predictive AI to lift conversion rates 15 to 20%. Alphabet's $40.3 billion net income and Meta's $29.1 billion prove ad-driven AI pays back within quarters. Cloud AI remains the speculative bet. Enterprise software AI monetization accelerates. Oracle's $40.4 billion revenue includes AI-embedded fusion applications at no extra license fee, a retention play. ServiceNow's $1.1 billion net income validates the per-seat model. The pattern, AI as feature, not product, protects margins without CapEx intensity. Free cash flow divergence tells the story. Microsoft generated $74 billion FCF despite $56 billion CapEx, 32% conversion. Amazon burned $10 billion FCF on $83 billion spend. The market rewards FCF resilience. Microsoft trades at 30 times FCF, Amazon at 45 times. Capital discipline is being priced. Regulatory overhang looms. FTC and EU investigations into cloud AI bundling practices could force unbundling of infrastructure and model access. Microsoft's OpenAI partnership, Google's Vertex AI exclusivity, Amazon's Anthropic investment all face scrutiny. A consent decree mandating open APIs would reset the competitive dynamics. Geopolitical supply chain fragility persists. TSMC Arizona Fab 21 produces 4nm, but not 3nm yet. ASML high-NA EUV tools ship at 1 per quarter cadence. China's mature node expansion creates oversupply and trailing edge, but leading edge remains a single point of failure in Taiwan. Hyperscalers stockpile 6 months inventory. 2026 earnings season delivered reality checks. Microsoft guided Azure growth 31 to 32% decelerating. Amazon warned AWS operating margins would compress 50 basis points. Meta maintained CapEx guidance at $37 to $40 billion. The narrative shifted from build it, and they will come, to show us the incremental revenue per GPU. Capital allocation signals intensify. Microsoft authorized $60 billion buyback alongside CapEx, signaling confidence. Meta added $50 billion repurchase. Google's $70 billion buyback dwarfs its $48 billion CapEx. The message, we can fund AI build-out and return cash. But buybacks at all-time highs risk poor timing if ROI disappoints. Long-term demand drivers remain structural. Global data creation grows 23% CAGR. AI inference could consume 10% of global electricity by 2030. Sovereign AI initiatives in Saudi Arabia, UAE, Singapore, and Japan create new buyer cohorts. The spend is not cyclical, it's infrastructure for the intelligence age. Technical scaling laws face diminishing returns. GPT-4o required 100 times compute of GPT-3 for marginal benchmark gains. The industry debates whether next frontier models justify $10 billion training runs or if efficiency innovations like mixture of experts dominate. Moody's and Gartner flag concentration risk. Moody's downgraded outlook on 3 hyperscalers, citing aggressive investment without commensurate revenue visibility. Gartner predicts 30% of AI projects abandoned by 2027 due to cost overruns. The analyst community is no longer cheerleading their auditing. The reckoning arrives. We are in the deployment phase of a general-purpose technology. Like railroads in 1870 or fiber in 2000, overbuild is inevitable. Winners will own the application layer: search, advertising, enterprise workflow, not the commodity compute layer. The ROI question answers itself when AI becomes invisible infrastructure. $230 billion bought the world a compute substrate. The earnings will follow, but not on the timeline quarterly reports demand. The companies that survive the digestion period will be those converting silicon into sticky software revenue. This has been an investigation into the physics, economics, and geometry of the AI build-out.